All right. Well, perfect. So why don't we use that as a segue into your paper? So I'm really happy to to welcome Nancy, who spent a lot of time. I think Nancy and Matt have probably been some of the earliest people thinking about various aspects of of climate. Nancy spent a lot of time in real estate market, also energy efficiency as a sort of an important topic. And the paper today and sort of Matt and Amin's paper later, kind of giving us two different insights into how climate risk is affecting mortgage markets. So Nancy, thank you very much for spending the time with us.
Well, thanks very much for having me. And obviously this is work with others. So Richard Stanton, Carlos Vergara, and Paulo Isler. So this has been a huge data effort, echoing what has been said up until now, that you're facing merging many data sets together. And we are also working with physicists on the physics of fire. And I actually believe there needs to be more linkages between finance and some of these physical modeling efforts that are now ongoing. So this paper is looking at fire risks in California. It's the last time I gave this with Johannes. I'm at home. The sky was orange because of the fires that were happening in Napa. So the sky in the Bay Area was orange for 3 days. I mean, literally orange in the middle of the day. There are huge fires in Southern California even now, so our fire season is much expanded. And as I say here, these are just some statistics. And obviously the whole state isn't on fire as I'm showing you here. This is just to give you a sense of how broad-based the physical geography of this problem is. So the areas burned are increasing very rapidly, and especially in the last 3 years. 2018, we had a big expansion. It was much in the news. It was about a $16 billion loss. It was a very heavy loss in life. A whole town was burned down. And there's much discussion about the wildland-urban interface, but as you're going to see in the talk, that basically covers most of California, and I'll show you why. And then in 2019, there were only 2 wildfires in Southern California because Matt's on the call. Several of these wildfires have been associated with Tesla batteries. And Matt was the first one to point to Tesla batteries as showing a concern for the environment. And basically, these are car accidents when Teslas hit a tree, they set the grass on fire. And if you're in Los Angeles and you set one of these fires, you're talking about very large risk. So just in 2019, there were only 2 major fires, and they cost together about $25 billion in risk. So depending on where it is, the risk exposure is very large. And then of course, we're not through 2020 yet, but already in 2020, we've had more than 9,000 fires. We burned 4.2 million acres. And again, we're seeing deaths associated with this. And so we became interested in this. CAL FIRE agreed to share their data. We have a lot of mortgage data and house price data. And so we joined forces and also joined forces with people at the Lawrence Berkeley National Labs to try to understand some of these issues. What are returns? What's going on? What happens ex post after these fires? And then take advantage of the mapping that the scientists in the state have been doing to try to quantify what's going on. So 2 quick facts: temperatures are rising, maximum temperatures are rising. This is all collected from the NOAA data. With my physics colleagues, we're using satellite data so we could get this more and more fine-tuned and actually map this to the Earth's surface. Also precipitation, we've been in a long-term drought, and we can't seem to get ourselves out of it, at least not in the recent few years. So the purpose of this study is it's primarily an empirical investigation of the link between fire events house price and size dynamics, in other words, the stock of housing, mortgage default, and then this is a PhD class, and I wanted to talk where we're going. The meetings are coming up. All of us are getting papers ready for the meetings. We have revise and resubmits we're working on, and we're adding demographics. So we have house-specific demographics over 20 years using some new data that are now available to allow us to look more carefully on the demographic implications of what we're seeing in the asset price part of the market. So we're going to be looking at the characteristics of the stock of housing in both the treatment and control areas. I mean, just this first bullet is an important multi-year data effort because the data we're using has characteristic specific panels. So each house, we know what the characteristics on that house were that year along with their prices. So we've been working with data vendors to mount the old data tapes so that we actually have a panel of house price characteristics. So we can model the size of housing, how many bedrooms, bathrooms, etc. So we're also interested in housing returns, both in the treated areas, the fire areas, and of course they evolve over time and they're rebuilt, and the areas that don't burn. We're interested in mortgage default, and the mortgage market actually turns out to be quite convenient because we've found the insurance industry totally unwilling to work with us. They will not give us, house level insurance data. But we know from the mortgage market that every mortgage has to have a mortgage insurance policy, and it has to include casualty insurance. So casualty insurance is a bundled risk, fire casualty, and that means that the pricing problem is more complicated, and we'll talk about that later in terms of future directions that we really do need to think about. And then lastly, the degree of gentrification in these areas post these traumatic events and large-scale fires, and that's where the new demographics are going to be very useful. So we're very focused on geospatial data and fire prediction. There's a reason for that. And the primary reason for that is that in California, for reasons it's very difficult, well, it's not that hard to understand, but we are not allowed by the California Department of Insurance to use probabilistic models to price house price insurance for casualty risk related to fire. Now that may seem really extraordinary, but that was one of the features that we really wanted to address in this paper, that is not a long-standing sustainable policy. Obviously, the response to that is that insurance companies cancel policies, which is what they're massively doing. And I recently gave a paper at Stanford, and there were 3 faculty on the Stanford people on the audience that had just lost their house price, their insurance. And this is a major problem in California, and that the insurance companies no longer are willing to insure. So we're interested in the predictability of fire. That's why working with scientists is important. And we were trying to understand how dynamic these physical processes are, and then what the implications of all of this is for fire insurance pricing and mortgage lending. So just a very quick case study of something that's very close to the university. So the university is right up here, just to the northeast of this graph. And this fire happened in 1991. It was one of the largest fires in the history of California. It destroyed a lot of houses, both multifamily and single family, and a lot of other durable goods. And at the time, it cost $3 billion, and that was the largest fire in the state of California. And this is going to give you an idea of how we're going to handle the identification in this paper, in that for every house, we have mapped it onto a CAL FIRE zone. This is the boundary and the extent of that fire. And then we have rings that are geographically close to, in other words, abut, and then rings where literally you cannot see the fire area. So everything has been geocoded in this way. Another feature that's really important are the physical elements of California. Terrain is a very important feature of fire in the California. The slope aspect, in other words, are they southern facing slopes? And of course, a lot of the housing are on slopes because of the view. The temperature, which I just showed you, is rising, and wind, and especially wind that comes from the Central Valley to the coastal areas, which happens in the fall and now in December. So these strong, dry winds that come down slope, superheated from the Central Valley, and then dry the vegetation and start fires very quickly. So what did we learn from that fire? Well, we learned that 95% of the properties were rebuilt. They had to be, they were newly reconstructed, and those newly reconstructed properties, the growth rates for those properties were extremely healthy. And nearly all of them were larger properties. So that's what we saw there. We saw very low mortgage default rates in this area. We didn't see default rates until really 2010 or 9, when these very large houses with their new very large mortgages began to be exposed to the great financial crisis. But even there, it was below the national averages and way below average in California. The long-term disincentives for mortgage default lasted a very long time. And there were these very important coordination externalities, or gentrification, if you want to think of it that way, in that large tracts of houses, remember this was 3,000 houses, and 95% of them were rebuilt. The homes were rebuilt to code. That's California law. So they were better houses than what burned down. And interestingly, fire insurance is priced in California on deterministic maps. In other words, maps that almost never change. And they allow, as I said earlier, no probabilistic pricing, no actuarially fair pricing of the insurance, and no inclusion of reinsurance costs in the premium. So there have been lots of fires, as you can see from my first slide. And this is an example of the data that we got from CAL FIRE, which is, these are the fire districts. So these are fires. Some of these are very large fires. Some of them are smaller. And we're using all of these fires. So there's upwards of 10,000 fires in our data set, and upwards of about 50,000, almost 100,000 homes. So again, the structure in terms of getting identification to be able to say something about returns and gentrification and what's going on in a way that's credible. We have our treatment groups. Those are delivered to us by CAL FIRE. The boundaries of those treatment effects are homes that were burned or partially burned, and they were identified by the fire departments locally and by CAL FIRE when they send in the scientists. So we believe these boundaries are not really subject to, they're not really endogenous, they're really the limit of the fire. Then we have a control area, as you can see here in paler orange. And this is a very big fire that happened in 2007 in San Diego called the Witch Fire. And then there's a second control area that is really quite distant, 1 to 2 miles from the area. And you can see just for the Witch Fire, how many mortgages were involved and how many properties were involved. We're talking about quite large numbers. So given our case study, the first thing to see is how generalizable from what we saw in the Oakland Hills, where we can run around and measure everything, how generalizable is that for these other fires? And what we find is for big fires, and we're going to be very careful about defining that. So these are fires that are more than 1 standard deviation in terms of acreage from the normal, quote unquote, 10 of the 10,000 fires. What you see is that the house prices, the 5-year effect on the houses within the treatment, the bright orange area, they're larger, both in 5 years and also in 10 years. So the effects of these very large fires on the housing stock, the size of the housing stock, the supply of housing, given the build to code requirements, grows in big fire areas. And it also grows in the non-big fire areas. So fire seems to be a good thing for housing. But remember, the only reason for this is because casualty insurance exists and it covers these losses, and casualty insurance is required. So big fires and fires seem to expand the housing stock. And then when you look at house prices or returns, we see very similar things. We see that big fires, both in a 5-year horizon and in a 10-year horizon, have about 5% effect on prices. So house prices grow substantially in these areas, much and more substantially in the big fire areas than in the smaller fire areas. And this is controlling for all the usual other attributes. So moving from these two features, obviously mortgages are collateralized by houses. So knowing that you have to have casualty insurance on a mortgage, and we know it's collateralized by the mortgage itself, the first thing that we look at is whether the probability of mortgage default conditional on a wildfire in the treatment area is higher than the probability of default in the control area. So this is a classic straight up diff and diff where we have these treatment and control areas, and we're going to look at the effects after fire. So now we're not controlling for big fires, we're just looking at the effect on fire. Okay, so that's the first hypothesis. And then we have a stylized model of a mortgage market and the embedded options and how a borrower would react to those embedded options. And obviously, just like in any option pricing framework, the mortgage borrower can either keep the mortgage, they can default, or they can prepay. And then if they're treated with a fire, their options are now expanded to either rebuild or not, and then keep their mortgage, default, or prepay. And obviously, because the mortgages are insured, the decision maker in this model is the borrower. The borrower is compensated by the fire insurance insurer for their loss, depending on what the quality of their coverage is. And the coverage typically requires building to local codes. So there's a pricing schedule. You can have more insurance to build to code, but all the policies require build to code coverage. So the homes are being built to a higher standard because the building codes are changing all the time. And that is borne by the insurance policies themselves, how they're priced and how they're structured. And obviously the premium are being paid by the borrower. And then rebuilding presents large externalities, especially in these large fires, where thousands of homes are being rebuilt to a higher standard. And so the larger the fire, the greater potential for gentrification externalities. So that's what our model gives us, and gives us surfaces that we can bring to the data. So the second hypothesis that we're going to consider here is that the probability of default conditional on a wildfire decreases, 1, with the probability of rebuilding, 2, with the house price conditional on rebuilding, 3, on the house price conditional on not rebuilding, and the size of the fire. And so again, this is another diff and diff, where now we're controlling for very large fires that generate these very large externalities, or at least potentially do, because of the build to code feature of the insurance itself. Okay, there's some measurement problems here. This is a big data set. There are lots of dimensions to it, but it's not perfect. So for we're going to need to proxy for the probability of rebuilding and also the conditional probability of prices post-fire. And obviously measuring that is difficult. So what we're going to do is proxy for that with very large fires. So very large fires, the probability of rebuilding is higher. That's because most California homeowners and all mortgage borrowers have casualty insurance. And secondly, with large fires, future house prices are higher, as we've seen in the empirical data that I showed you in the panel regressions initially. So there appear to be positive benefits of coordination externalities associated with these build to code requirements. And so we're going to proxy for this probability of rebuilding and then the conditional price distribution using the big fire dummy variables. And it equals 1 if the number of mortgages affected by fire, as I said earlier, is at least 1 standard deviation above the mean number of mortgages affected by all California fires, and equals 0 otherwise. And so this is a straight up diff and if where we have our controls, that's the bright orange. Then we have the 2 rings, one abutting the fire area and the other 2 miles away. And the third column shows you that the big fire areas have, these are foreclosures, we also do at default, have lower foreclosures. Yes, it's positive for if there is a fire, there's more probability of default, but in a very large fire, there's less probability of default. And this is nearly exactly the same result looking at just delinquencies, 60-day, 90 days. So then we also try a panel regression. We really want to start thinking about pricing insurance. So we wanted to do forecasting of fire. So we're interested in the ability to forecast fires and potentially link with the physics of fire and do a better job of forecasting the incidence of these events and their magnitude. So we're going to estimate the probability of fire. We'll use NOAA data. So we have nearly 100 NOAA measurement stations in California that we map onto our data. We measure the maximum temperature by month at all the property locations year by year. And so our first stage here is predicting the probability of fires, accounting for these important geographic and seasonal effects on the likelihood of fire, and then comparing them to the deterministic maps that California actually uses. And California has a very stylized mapping system with only 3 gradations. They keep it very flat, so there is not a lot of pricing differentials by the nature of the terrain. And that's because it's done by a panel within the Department of Insurance. Then the second stage in this IV regression is going to be month-by-month measurement of mortgage delinquency or foreclosure, basically a robustness check essentially on the diff and diff specification. And again, looking at the probability of foreclosure and delinquency. So what we find is that temperature is very, very important. It's the wind. We measured all kinds of temperature, geographic related variables, but temperature is absolutely the most important. But the key thing here is these are the 3 hazard zones that the California Department of Insurance uses for the pricing schedules. And as you can see, our estimates show they aren't even monotonic in these hazards. So this is the most hazardous, 1 is the least hazardous, and as you can see, the second has this is the most risky, but this is the least risky, and yet it has a very high probability of fire when you're using these ever-changing temperature measurements and accounting for terrain. And this is what you can see mapping this. This is very dynamic. So this is going over the seasons. And as you can see, these just using temperature with these probabilities, you get very big differences over the seasons in terms of what the probabilities of fire are. And there is the California pricing map. So all those bright orange things that we had in here don't appear on this map, even though as this heats up and the wind comes down these slopes, these are exactly the areas that burn. One other thing that was very surprising to us is these fires happen in the same place very regularly. So the Oakland Hills fire, that was the third fire that had happened in that exact same area. And that's true for many of these fires. So what we see here is in the IV, again, we see that big fires have a mitigating effect on mortgage foreclosure, as they do on mortgage delinquency, suggesting that there's important externalities associated with these big fires. But of course, that only happens if we have insurance and the insurance companies are willing to pay up when these large events occur. So then we go ahead and use our forecast of prediction of big fire and the size to estimate the expected fire losses given those predictions. And we come up with something that's ballpark on an annual basis of the losses. Our data go to 2017 of about $15 billion a year. And we've exceeded that already with the fires from this year and the end of last year. So just to conclude and then think about where we need to go in thinking about this, we're finding very important effects on long-run house price dynamics. For very large fires, they appear to be very positive, so the mortgage market is very well protected, as long as the insurance companies are willing to stand up to this risk. And of course, that's the major issue. They are not. And then the long-run dynamics of the stock is also very dependent on this large externality associated with big fires and gentrification. And then delinquencies appear to fall because of these coordination externalities and the requirements that everything is built to code. So we find very elevated returns in big fire areas. We find very elevated growth in the stock in big fire areas. And we find significant mitigation on default. Of course, the big question here is the provision of insurance and the unbundling of insurance. So the big news is fire casualty insurance was always treated as its secondary risk. As of this year, that is no longer true. Casualty and fire casualty is now a primary risk, and the reinsurance market is treating as a primary risk. So the cost of insuring these markets in these densely urbanized California housing markets is going to be very prohibitive. Basically, right now, what happens is the policies are canceled. The alternative is a mutual fund, just like our insurance mutual fund, which is now capitalized to cover these fires. And so we're really facing a potential breakdown in the fire casualty insurance markets in California, unless we think a little bit more carefully about how this risk is priced and what the long-term implications are for supporting the mortgage market, which all of you know is about 50% of Fannie and Freddie's balance sheet. Thanks. So I think I also just want to reiterate the data exercise in terms of the number of questions here, that as we build these big data sets to make them available so that people can start pushing this, because it takes way too much time to do this paper by paper. There needs to be a more coordinated effort. Thus far, I've failed in California to get them to be willing to share at the state level, but that's my goal, to try to get this material in the domain of researchers so that we can start building models, better understanding what the economics of all of this and the implications of all of this for pricing and risk management. So I'll stop there.
Perfect. Thank you so much, Nancy.